Perfect. It is 10:18, so like a golf tee time. We shall get started. And that was Abe Silverman who already got us going here. So welcome to the second session of the day. And we will be talking about finance and investment in existing and emerging technologies. And the motivating question here is what investment structures and risk-sharing models are needed to accelerate transmission and clean energy infrastructure. Our chair today, our moderator, is Abe Silverman, who is with Johns Hopkins University. This is a first for ESEEC having this panel, so I'm particularly excited to hear the conversation. And like Abe said, let's have a good, open, vigorous discussion here. I'll turn it over to you, Abe. Thank you.
All right. Good morning, everyone. Abe Silverman, Johns Hopkins University. But really, I'm a recovering FERC attorney. And for many years, most of my career, I actually worked as at an independent power producer. I'm really struggling with these questions of how do we finance the next generation of technology, and how do we deal with investment price signals that maybe aren't really quite telling us the right thing, and certainly aren't driving investment in the kinds of technologies that we need for the clean energy transition. So I am really thrilled to be joined by just an absolutely, I think, all-star panel today, where we have a bunch of different perspectives. We have perspectives from bankers, we have perspectives from academic market designers, we have perspectives from people involved in financing new projects. And I'm really hoping that we'll get into this question of how do we think about the next generation of power plant finance in this country? And how do we deal with the fact that we're being asked to invest in just a ton of infrastructure? I hear there's this new thing called AI out there, apparently uses a lot of electricity. So how do we think about financing that next generation of clean energy infrastructure within the political constraints? And I'm very interested to talk to the people here on the panel today because they really do have that practical perspective and are going to talk about, what does the regulatory risk look like if we start pricing consumers out of the energy and capacity markets, and how do we deal with that? Is re-regulation inevitable? I asked that during our prep call and got some real, some violent objections, but I'm going to ask it anyway. So let me go ahead and introduce our panelists real quick. We have Kelly Joseph, Vice President of Electricity Markets and Policy Credit Risk at Fifth Third Bank. We're going to ask her what that means. I see, actually, my intros here are not quite in order, so let me, we have Jacob Mays, Assistant Professor at the School of Civil and Environmental Engineering, and one of the people that's go-to for energy market design issues. We have Brian Long, who's another former colleague of mine at NRG, as is Kelly, actually, who is Executive Director of U.S. Power Origination at J.P. Morgan Bank. And then last but certainly not least, we have Lou Schick, who's the Director of Clean Energy Ventures and has had a long career working in different parts of the industry, driving actual investment in actual infrastructure. So just as we get started today, we asked Kelly to put together a few slides about sort of, what are the things that folks need to know about finance and credit risk and some of these other issues. So we'll get started with that.
Thanks, Abe. So what I thought we would do, what we're planning to do is just to have this be pretty interactive. So Abe's going to ask questions. We're going to have the audience ask a lot of questions. But I thought, especially for this audience, I'd kind of try to level set at a high level, kind of how some of this works, what it is that we're all doing, and what some of, as we go forward and think about particularly, the kinds of technologies that have relied on a lot of subsidies, whether that's, existing technologies or potentially newer technologies, where we see, some of the challenges and what might be happening as a result of some of the changes at the federal level. So before I do that, I will say there are different aspects. The reason why I have credit risk in my name to answer that question, I'm not someone who is at the bank originating loans like someone like Brian. I'm in credit risk. So I'm on the team that's helping to assess the risk appetite for the bank and looking specifically at individual projects and understanding where and how we might want to mitigate risks that we see and whether or not it's something we can mitigate and would continue with the project or whether it's something we think it might be too risky and we might not want to get into. So I'm going to talk a little bit about the basics of the capital stack. So this is very basic, high level, specifically for project finance. And for those of you who maybe don't know, project finance is a kind of different animal. So typically when you have a company and they put something together, they have a balance sheet that if something goes wrong, you have access to particular funds that are associated with the company itself. In project finance, you're actually the only way that you can get repaid or get your money back is from that very specific asset itself and the cash flows that it generates. So it's a little bit different than some typical investing, but the concepts are still there. So in general, when you're looking at any investment, there's kind of two types of investment. Either you're getting equity investment or you're getting debt. Equity is much more expensive because it's much riskier. And typically this is where you're having, lots of capital, high capital investments from riskier entities. So someone like Blue who's doing venture capital, or you're having, individual, owners, et cetera. Another type of equity that's been relatively recent, maybe in the last 15 years, is tax equity, which I'll talk a little bit about. And then the other component is debt, and that's typically coming from various types of lenders. Thinking about what actually happens when you develop a project, there's different aspects, not just in the construction, but once you get into actually having a power purchase agreement, thinking about who all of your suppliers are, and then how you're going to actually monetize what it is that you're doing. So all of the pieces of that can be financed in different mechanisms, and we can talk a little bit about that. But in general, this is how to think about it. So equity, most expensive, typically where you're seeing a lot of the risk, and debt is typically, less risky, but, there's still risk in there. So the basics of tax equity, which is a lot of how solar and wind and storage projects have been financed. And this is because of, federal subsidies and investments in production tax credits or investment tax credits. But the challenge is that a lot of the companies that would rely on tax equity don't actually have the ability to monetize the tax benefits from that. So what has happened is we've introduced a new category called tax equity, where you're actually seeing other investors come in and act sort of like, typical equity would, except they're the ones that are actually monetizing the tax benefits that come from the federal subsidies. So they're getting things like accelerated depreciation and, all of the tax credits that come along with that. And you're probably familiar with, the PTC and the ITC, and then these added bonus credits that came through the IRA, whether or not you have domestic content or in an energy community, a low-income community. An energy community was somewhere where there was a fossil asset, and now you're introducing something new. A lot of times tax equity is actually structured to enable sort of the next tranche of investment for specific construction financing. And then there's various structures, which I'm not going to get into, but essentially this idea of a flip, right? So you have the tax equity investors sort of like a sponsor, but they're not looking to be the sponsor for the long term. So they become sort of the one of the owners of the project, and they have a certain return that they're looking for. And once that return is hit, the ownership flips back. And the tax equity entity is no longer, receiving the majority of these benefits. There's different structures, like I said, partnership flip, sale leasebacks, or inverted lease structures, but we won't get into that, just to let you know that there's different ways to structure how tax equity works. So when we talk about these, projects that are in specifically project finance, again, where you're specifically talking about the cash flows associated with the project themselves, there's a couple of things, many things to think about when it comes to risk. So one of the ways to de-risk is to actually have a power purchase agreement. These could be virtual contract for differences. This is a lot of what we typically see, especially more recently with solar and wind and batteries, et cetera. These could also be physical contracts as well. So contracts for the actual energy production where it's happening. Within the PPA itself, there's lots of, I just put a handful in here, but there's lots of elements in there that come with that have risk associated with the PPA itself. But there's also components in there that are pretty structured. So there's a term, so you have some certainty in the cash flow. It could be 10 years, 15 years, 20 years. There's very clear mechanisms of what happens, what would constitute a default in the PPA. The pricing is clear in there. So you're getting paid for usually the energy and the RECs associated with that production. You have some performance guarantees, availability guarantees associated with that, and not hitting those targets introduces some risk, potentially some liquidated damages that might be required, or you might end up in an event of default. Along with that, so typically, especially in a non-physical, but in a virtual contract where you're seeing a lot of the corporates do this. So when a corporate, for a data center, for example, has a solar project and they're using the PPA associated with that project and paying for the energy and the RECs, one of the things that happens is that project is not actually settled at the point of injection. So instead, the project is producing at a particular location, but the settlement is taking place somewhere else, usually at a hub within, like an ERCOT or a MISO or an SPP. So that means that there, in addition to, you have these performance guarantees and a pricing structure that is settling at a particular point that's different from where the project is actually located, that introduces other types of risk into the contract itself. So sometimes the PPA will have clear indication of who wears the curtailment risk for the project, usually the project itself, since they have these availability guarantees. Who wears negative pricing risk, and then this concept of basis. So this differential between the price at where you're injecting and where you're actually settling the contract. So more in the PPA than what I've listed here, but that gives a sense of kind of how some of that is structured. And then in general, we're always thinking about who wears the risk in all of this. So who's wearing, and some of this comes through the PPA and some of this is happening, prior to the PPA itself. But who's wearing the over budget, missing deadlines? What happens if you don't reach commercial operation when the project is intended to reach that timeline? Is the technology something that is known? Is it unknown? Who wears the risk of how the project actually operates? Is there counterparty risk? Are you entering into this agreement with someone who actually will remain solvent and can continue to pay you? Again, going back to the revenue risk, how are you actually receiving these payments? Where is the risk introduced when you're actually thinking about how the project gets paid and these cash flows that are really critical to the success of a project finance? Who wears the performance risk? And then what happens when you have changes to existing laws and regulation? And a lot of this is or is not spelled out in the PPA, and some of this, you have to really think through as you're assessing what's there. So this is the last slide, I think. But I wanted to talk through a little bit of, actually, I have one more slide. What happened with the one big beautiful bill? So everybody's familiar with the Inflation Reduction Act and those tax credits that I mentioned. They had a pretty long runway associated with them. What happened with the one big beautiful bill is that has all changed. So especially for, solar and wind projects. So depending on when a project either starts construction or is actually placed in service, now the tax credits themselves may or may not be available. So before, if a project was put into place, and I want to stress, especially for planners, this is something important to think about. So, where are these projects coming and what's going to happen as we're going forward? If you're a project